Welcome to This Week in Intelligent Investing, where we examine timely and timeless investment topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Chris Bloomstran, Phil Ordway, Elliot Turner, and other thought-leading investors. Brought to you by MOI Global. And now, here is your host, John Mihaljevic.
A warm welcome to everyone to Season 1, Episode 4 of This Week in Intelligent Investing. It's a great pleasure to have with me Elliot Turner, Phil Ordway, and Chris Bloomstran. Elliot, welcome back this week. We missed you last week. So glad to have you here. And I'll ask you to go first because you have a topic that has been discussed a bit in the past, including at an MOI Global event that you attended. It's a topic that resonated with everybody who was at that talk, and I think our listeners today will enjoy it as well. So we'll go to you first, then to Phil, and then to Chris. Go ahead, Elliot.
Awesome. Thank you, John. It's great to be back with you guys. Missed you all last week. Good to be connected to the world again, too. You know, stay-at-home orders with no power cable lines coming to your house takes it to a whole new level. So I'm excited to be back. And this is a topic that I asked a few of my friends what they wanted to hear me talk about. And these people have heard me speak about this topic, and yet they can't get enough of it. And it's position management and kind of the intersection of position management with the research process as well. And it's something that there's little literature on, and I feel like doesn't get talked about a lot alongside investment. You know, there are plenty of textbooks written on how to invest and break down businesses in various ways, but not much on position management. So what I wanted to do is really more prompt a conversation by sharing part of my framework and how I think about it, because both I think of my framework as a work in progress that I'm constantly trying to improve upon. And I want to hear what, these other smart guys with me think in their own right, and what you all out there think yourselves. And maybe I could get better and better at it. So to me, position management starts before you ever even own something. You have to do the work. You have to get an idea of a price you want to get involved. And you have to follow something on your watch list. You have to keep learning more as time goes on. And then the more you follow something, the more you learn about it, the more conviction you're able to inevitably get. So sometimes, what might have started as a very low price, waiting for stock X to fall 20%, the more conviction you could get, maybe you could step up a little higher, but also maybe, it works the other way. Either way, you're learning more over time. And the longer you do this, the deeper your well of knowledge on a given company, the more you know it, the higher your conviction can inevitably be if you do take a position. And then, next, not enough investors appreciate George Soros. And I think he introduced this idea that every position you take in the market is a testable hypothesis. In other words, the market's giving you feedback every time you make an investment. So obviously, the day you make an investment, you're effectively tossing a coin. Like you're hoping it goes up. I mean, maybe you're hoping it goes down if you want to buy a lot more, but effectively, you're hoping it goes up. But it could go down just as easily, right? It's a 50-50 chance that on that day, it's going to go up or down. 3 days later, it's still close to a 50-50 chance. But the longer your time frame goes, the more your work gets to stand for itself. And, that's that Ben Graham concept in the short run, voting machine, long run weighing machine. So you don't want the direction the market moves early on to sway you. However, you are making a testable hypothesis, and sometimes the feedback from price is something important that you should be thinking about and synthesizing in your understanding of what's going on and what's driving a stock. So one thing I think about a lot is I like starting slow and building a position. In doing so, you learn about the position and you learn about yourself. So one thing I've settled on is this idea for myself that if I ever fear that if something went lower, like meaningfully, when I own it, I should sell that day and revisit later because I don't have conviction and I'm a weak hand and I'm not truly, I'm not knowledgeable enough in the idea. But then another thing I think about is when you're in a stock, when you're there, when you are an owner, you are subject to different forces and you start getting an appreciation when you see things move around for what drives the stock, what people are looking for in the stock. Listening to an earnings call in real time and hearing the tone of management and the tone of the analysts asking questions is very different than going backwards and reading every transcript for the past, however many years. So you start feeling differently about things and seeing things through a different light. And to me, I find, some pretty good insights in there where you could really identify those kind of wedge issues and figure out where you have a truly divergent position from the consensus. And that sometimes is an important signal where you should take that smaller position to something much larger when you believe very strongly behind that divergent position. And ultimately, like, to tie it all up, I think, investing is this quest for conviction. Like, your goal is to find positions, not just that you think are good risk reward, but ones that you could see through even when things aren't necessarily working their best for you, right? So, the behavioral forces that we're exposed to with the market's trying to impose its will on you. It's trying to take advantage of the fact that we as individuals are all fallible, and it's trying to, expose our human biases. And so the more work you do, the more you understand a position, the more you have been exposed to the ups and downs in it, the more you are able to stick through the hard times and hold things. So one thing that's kind of nice coming out of a period like March is, I'd hope, for me, I feel this case, but for everyone out there, that you end up owning the positions, only those that you have the most conviction behind, that you truly absolutely love, that you can stress test and believe in under the harshest conditions. So that's kind of my framework on a position level. And just want to open it up to you all to kind of hear your perspectives and anything that might be different.
So what's the smallest position you'd be willing to take then?
Yeah, so that's slightly outside this framework to an extent, insofar as if something has like a 10-to-1 chance of paying off, and let's say, the way it wouldn't work is it would be a 0, I'd probably size it as like a 1% position, 50-50 shot of a 10-to-1. I'd put 1% of my portfolio in that. In theory, maybe if I had a series of infinite opportunities as such, I'd be much larger, right? Kelly criterion would suggest as such, but we don't have an infinite series of them. For the most part, in my core positions, 2% would be where I'd start, 2 to 3%. And inevitably, we have a different mandate in SMAs than the hedge fund, but I'm looking to get everything up to like 10% if I can.
One thing I do, Elliot, is... Go ahead, Phil.
No, I was just going to say, I think that's the hardest part is for me finding those improbable but skewed in your favor kind of positions where, you're certainly not going to put 10% in them right away. But if you had 100 of them, you'd probably neglect some of the work you'd need to do. Again, you're not going to find 100 of them, like you said, but it's always an interesting debate for me.
Yeah. One thing. Go ahead. Sorry.
No, you go, Chris.
Yeah, I was just going to say, we parallel your thinking quite a bit, which is generally starting with smaller positions, kind of 1-2%. I've started in some cases at 4 or 5. In almost all cases, we've spent lots of time following the businesses that we wind up buying because most of our process revolves around kind of our intrinsic value measure and the discount to intrinsic. But I'm curious, one thing we do is position size, kind of based on market cap or what we perceive to be as a little less riskiness of a position. Much smaller cap businesses we will never allow or tolerate to be, huge positions in the portfolio. Berkshire obviously, sits at the top of our portfolio as a big position. We've had several that have been kind of between 10 and 15%. But those are very knowable businesses with very predictive earning power. I'm curious how both you, Elliot, you and Phil think about position size versus, I wouldn't say so much the knowability of the business, but how you perceive the riskiness of the business.
Yeah, and not to say that I think of volatility as risk, but volatility definitely comes into play. So I'll give a specific example. With Roku, I had a really hard time thinking about how to size it at first because I started small. I had quite a bit of conviction, but in the first 13 days I owned the stock, I didn't see a single green day. And then once the calendar turned, so this was December 2018, once the calendar turned, I think I counted the days. It was like 3/4 of the days in the first quarter. It had an intraday range greater than 6%, which is just absolutely nuts. But my conviction was really high. And so I've tried to strip that away And I try to think that more in terms of like stratifying the risks and the variance within the portfolio. So, if I built an entire portfolio of those kinds of securities, I'd probably never sleep at night, nor would my clients. But if that's a portion of the portfolio, it's very different than if it's everything. So, when I build a portfolio, I want to take that into consideration. I want to diversify my market caps, my kinds of risks. I really want to stratify the risks in the portfolio so I have not too much crowding around one single risk factor. And I want to diversify the correlation. So certain things, like the growthier names tend to move together and be tightly correlated in value, and vice versa. I want to have a little bit of it all so that I could balance it out.
I think everybody thinks about position sizing, and they talk about position sizing when they're buying. But how do you think about position size when you're selling? How do you think about portfolio management? What's your sell discipline, and how does that relate to position size?
Yeah, that's the biggest work in progress here. I feel like half the time I overstay my welcome. The other half the time I sell too soon. It's definitely, like you said, an intrinsic value framework. So I think in those terms, but then at a certain point, I will, effectively treat it in a momentum way. So coming from a trading desk, I have a keen sense of like following momentum signals for trailing stops. So if I feel like something has achieved my objectives, even if it's a little overvalued, I'll let it run with kind of a mental trailing stop in there where, I'll get out once I feel like I've maximized, squeezed every little bit of juice out of the lemon. I'm curious to hear what you guys think on that front.
Well, there are a lot of reasons that you'd wind up selling something. Obviously, the best case would be your positions achieved 100% of intrinsic value, even trades north of intrinsic, to where the downside kind of outweighs the upside. The interesting aspect of position size is when you either think you're wrong, know you're wrong, you might be wrong. And, obviously, if you're starting at 1 or 2%, at least in our world, and I'm sure you guys, look at capital management the same, clients have a hard time getting their mind around the notion that you want to see your positions decline in price. Kind of famously, Mr. Buffett, Mr. Munger will tell you, you only want high prices at the moment you need your capital and you're going to sell. And so, if you've always got cash and cash flows in, you always want low prices and you want to be buying things. And so, if you're starting at a 1% or a 2%, which kind of tends to be how we do it as well, I cheer when price drives, and I don't think there's any diminution of underlying earning power or, value to the firm. The interesting aspect is, despite knowing business for a long time, if we think we're in a business where we may be wrong or where you wind up getting disruption, I'll say maybe it's an art and maybe it's the experience of doing this for a long time, but the places where we've cemented losses and lost money, we've tended to not chase positions lower. It's best case is price drops, nothing's wrong with the business, you add to the position. Price drops more, you add to the position. It can either be a one-off earnings miss or it can be a wholesale market decline. Where I've been wrong on the fundamentals, or where you get into a cyclical downturn with a business with operating leverage, a little bit of financial leverage, and you could wind up with a problem instinctively. And I don't think there's any quantitative way to do this, but there's an instinct that you get to where you don't chase position size down. I've had a couple occasions early in the career where you made positions bigger reflexively, and it's tended to be a problem. Curious how you think about when you think you're wrong, but you're not entirely wrong. Obviously, if you know you're wrong, you're going to sell a position entirely, but you don't want to get whipsawed around positions either. You don't want to be day traders. Ideally, I think you guys and I, are trying to get into positions for a long, long time and own them. And so how do you do that when you think you're wrong, but you're not sure you're wrong?
Yeah, personally, I've come to this conclusion because I've played it the wrong way. If I think I'm wrong, I sell now, because that means if price goes down further, I'll question myself further. And, it's even harder to build conviction. It doesn't mean I won't revisit the company later on. And, I'm doing this within a framework of keeping turnover pretty low. So we've been below 20% turnover almost every year until this year. But for the most part, yeah, if I think I'm wrong, it's a signal to me that I just don't know it the right way. And I'm probably not in the right spot because ultimately, right, I'm on the quest for conviction. So that means I don't have it.
How do you look at that, Phil?
Well, I think what pops to mind is there's a great part of Jeff Graham's book, Dear Chairman, that had nothing to do with activism. It's a great book on activism, but I still remember because I think it was the first time I'd ever heard somebody call it out, because we spend so much time talking about how you need to build conviction, and that's obviously true. If you're going to be an active investor and not index, you have to develop that conviction and do the homework and have enough of an idea of what's going on to take that position in the first place. And obviously, if you're going to do that, you can't have hundreds and hundreds of positions. You might have, for me, it's generally 8 to 12, maybe at the very most 15 positions. Generally, the fewer the better. It sounds like you guys might be a few dozen positions, but again, you're not talking about hundreds. But anyway, Jeff Graham put it, I thought, very, very well. And he said, if you're Buffett and if you're a good investor and you're doing the homework, conviction is your friend. If you're everyone else, it's going to be your worst enemy. And you're going to get just absolutely destroyed by that conviction for exactly the reason that you guys just put out there, which is it's very hard to know when you're wrong until it's too late. And if you have a lot of conviction and you have a big investment, being wrong is going to cost you a lot. If you're not convicted and you're agnostic about things and you own an index, you're definitely not going to get hurt by your conviction because you don't have any by definition. So I don't have an answer. I'm always trying to get better at this. I'm always trying to look for reasons why I'm wrong. Going back to what we talked about a few weeks ago, I just always tried to do kind of a pre-analysis on what it would look like to be wrong. And that's why it helped lessen the blow when the virus hit in March and I had to take 3 or 4 years of work in a really big position and sell it at thankfully a very tolerable loss, but a loss nonetheless, and get rid of our airline investments because it just became very clear immediately to me that I was wrong and things had changed. Lesser situations where it's less clear, I've definitely made a mistake by acting too slowly because my natural inclination is to trade very infrequently. Year before last, we only made buy or sell decisions on 17 trading days all year. I mean, we're generally making, a buy or sell decision maybe 2 times a month, 3 times a month at the very most. We've had 4 and 5 month stretches where we have done absolutely nothing. So, my natural inclination trends in that direction, but that can really hurt me if things are changing slowly and I miss it. So I think I'm always just trying to find those things that I'm missing and find areas of evidence to prove me that I'm wrong. And you just have to be intellectually honest. I wish I had a better formula or better framework than that.
How do you think about selling when things have gone as expected and position size grows closer to your appraisal of intrinsic value, but also disproportionately larger relative to the size of a portfolio?
Yeah, that's a great one too. And I can only give you an example. I give you an answer by anecdote, which is just yesterday, I actually sold, this position had more or less been what for me was a moderate sized position. So 7, 8, 9% position. This year, it's one of the relative winners out there in the world. It's more than doubled. It was up to about 16%, 17% of the portfolio, and at a level that I thought kind of fully accounted for its future prospects. I mean, it's a good business. It's going to grow. It's got everything I look for, but it's pretty much fully accounting for all those things. So I've started selling it. I mean, I just don't think it's going to grow enough. I don't think the management team's superhuman. It's got some drawbacks like most businesses do. So just yesterday I was selling pretty aggressively when the stock was up a lot. I get those decisions wrong a lot too, though. I do not have a monopoly on good decisions in that regard. I think selling something that's up, that's doing well, that's kind of working in your favor is generally one of the most common mistakes that people in our shoes make. Generally too quick to sell on the way up in those situations.
Yeah, I agree. I can say over the course of 30 years doing this, that's been really the biggest mistakes that I've made are selling something too soon, selling because you haven't moved up your appraisal of intrinsic value, selling because the size relative to a portfolio is larger. And the real boneheaded mistakes have come when I've completely eliminated a position size. I've written about Ross Stores, talked about it a few weeks ago, having made 2.5 times our money during the 2000 to 02 downturn with the stock. It was really cheap. Then it looked fully valued, sold it, thought I'd come back to it, never came back to it. And it was a 20 bagger after we sold it. And so I've learned over the years with businesses that I own that we want to own for a long time, I will trim a position back when the valuation gets extremely full. And I tend to trim incrementally. But one thing I've learned is to keep a name in the portfolio. So if I'm going to come in with a new position on the buy side at 1 or 2%, sometimes more, I'll take a position from 4 to 3, 3 to 2, 2 to 1, as I've done with Dollar General this year. I would take a business like Nike, which has gotten really fully valued, down to where it's about 0.5% of our capital today. But at 0.5% or even at 1%, I'm not going to get harmed if it takes some time for the underlying fundamentals to grow into the valuation. The risk I run is if I blow Nike out of the portfolio, or I blow Dollar General completely out of the portfolio, and I've got a constructive case that, in Dollar General's case, they're going to open 1,000 stores a year for the next 8 or 9 or 10 years. It's going to be a much bigger business. It will grow into its valuation. I run the risk if I sell the whole thing, I never come back to it. Where if I keep it in client accounts and portfolios, I'm more inclined to take it from 1% to 1.5 or 2% and incrementally buy it on more modest declines, even though it's not kind of my typical wide enough discount to intrinsic value when I buy something. It's probably the most valuable thing that I've learned over the years.
Yeah, that's actually one of the really interesting elements to me, because some of the best decisions I've made are buying more of companies that are working at higher prices, because I have an appreciation for why it's up and how it's not necessarily up enough to accommodate how much the business has grown or how well the business is executing. So I'm curious, Chris and Phil, how you guys think about that too. Because Chris, I know you said you have a similar framework on that front, starting small and getting into it. But obviously, if you buy something and it's going up, it's gotten bigger as a percent of your portfolio. If it's performed relatively well, so it's already bigger. But then you got to make the decision to buy up. So I'll throw out one idea that I think about as I do it, and then maybe hear your perspectives. But I have got into this framework of thinking, not in terms of what price I'm paying today in the market when it's higher, but given I already have a position, when I buy more shares, where do I want my average price to be? So knowing what I know, where would I feel comfortable having my basis be today? And it's not necessarily a perfect framework, but I think it's pretty helpful for me in knowing how to size it when I'm paying up, and how to think about it and feel comfortable paying, not anchoring to my starting point, but paying what I think is an appropriate price for my stake. So how do you think about that?
Well, two things that I'll do that really work are, one, always, you've got to maintain a discipline of going back to the things that you own and revaluing those businesses. So incrementally moving up and adjusting your intrinsic value measures. And it's not a weekly or a daily thing. I go through the process on a quarterly basis. And a lot of that is just maintenance, because very little should change if you own a good business from quarter to quarter. The stock price may bounce around a lot, but your appraisals of underlying intrinsic value tend to not move much, and they'll kind of grow with, retained capital. They'll grow with organic sales, but you've got to move those numbers up. If you leave those appraisals static and you've got a rising stock price, they tend to grow. The great thing that has happened in our world over, and in my world over the duration of running capital is, we've got we're fortunate enough to have, generally a handful of new clients hiring us over the course of each year, and new cash coming in, whether it comes in from an entirely new client relationship or a deposit into a client account, forces you to go back and rebalance and, initiate positions. And so if I've let a position run up in size and, I'm kind of underweight in various client accounts, if I'm sitting on a new pile of capital, either again for a new client or for a new deposit, it kind of forces me to go back across the portfolio for all of our clients and assess whether I want to add position size. And I don't think I'd be as disciplined as that if I didn't have, kind of ongoing flows into the portfolio. And it's just kind of the nature of the beast. You've got to do something with capital. You don't want to have new capital come in and sit with it for an overly long period of time. So you have to have a discipline and a process in place on how you put brand new money to work and how you put deposits to work. And that really helps keep kind of everything tight enough to where your modeling tends to work for you.
Yeah, I would say too that I totally agree that quarterly is probably the right frequency, and sometimes that might even be too much in some cases, but it's good to keep one eye on things, I think, at least quarterly, and kind of reappraise. I keep a running log, literally a physical notebook along with all my digital files where I do that every quarter. I just sort of run my eyes over the results and kind of reappraise what I think the business, realistically can earn and what it's realistically worth in a pretty wide range. And I then flip back to what I thought last quarter and last year and however many years I've been following the company, and just sort of use that as the benchmark to keep things adjusting and updating the numbers and updating my ideas in real time. I think that's the most effective way to do it. And beyond that, it just takes a lot of work and a lot of judgment, and you'll get that over time with experience when you look at these things enough.
I will take an intrinsic value calculation and adjust for balance sheet components of debt and cash and shares outstanding. And so a lot of that quarterly maintenance isn't so much, kind of moving around the multiple that I'm going to pay for something or the durable margin of a business, but it's really the quarterly maintenance of the incremental use of debt, either taking it on or paying it down. It's any incremental build in cash, and it's the net change in the share count. And so you'll see your intrinsic value per share just nominally move up and down based on those metrics. But the discipline there is you get into a pattern of 2 or 3 or 4 quarters where your debt numbers are incrementally rising. You go back and look and see where it's coming from, working capital. And a lot of times when you do adjust your appraisals on a regular basis, you can start to catch problems before they really come to pass. And it's not so much, I'm trying to make sure that my intrinsic value is always moving up with the growth of the business. But when you throw various, fundamental criteria into your valuation model, I find that to be immensely helpful.
Yeah, I end up with a lot of these companies, probably, certain higher frequency data points move things a bit more. So like a marketplace model where you have a combination of user growth, engagement, frequency, and call it average order value or ASP, whatever it may be. And, everyone try to hone in on one specific variable. In the case of most of these, I tend to isolate on engagement, and some of the moves on that on a quarterly basis could, meaningfully skew how you think about intrinsic value if you want to extrapolate a change. Or, do you weight it from a Bayesian perspective and, give more weight to what was there before than what's there now in that sense? But, definitely approach that exercise quite similarly of each quarter updating the intrinsic value and how I think about it, try to give more weight to what I thought before than what I think now in that sense. But sometimes you have these like meaningful shifts in how the business is in what it's worth. One of the interesting concepts I was introduced to as a documented inefficiency in markets is the post-earnings announcement drift. So stocks that have these catalytic moves on earnings, either up or down, and it was defined in the original study as an 8% or more move in either direction. The market tends to not price enough the extent of those catalytic moves one way or another. And so it gives you opportunities to act and make changes on the fly as things go. But, thinking about that in terms of the exercise, there's sometimes where when you update your intrinsic value and you see a big move, you're like, wow, that didn't move nearly enough. Those are some of the most interesting, opportunities I encounter in going about the exercise. And I think it's a big reason why it's so damn worthwhile. Just one of the many reasons, but that's something I tend to think about quite a bit.
Can you guys just talk a little bit more about this idea of buying a starter position and then increasing position size? I've kind of tended to just, if I feel like I've done the work, I have the conviction, I'll just pretty much buy a full position right away. The idea being, I'm afraid that if it actually starts working, I'll be forced to buy higher. And that's, I guess, psychologically, I have a problem with that. But how do you guys think about, that scenario where you buy a 1 or 2% position and then it just starts to run away?
Yeah, personally, I like to check FOMO at the door, right? I don't want to feel those forces working on me. So I've done several things in my process along the way that I call imposed patience. They're things designed to slow me down because my inclination tends to be more towards action, and I want to slow myself down at every step of the way, because the slower I operate, the better I tend to do, the better I tend to think, the better my framework and everything. So, I feel like more often than not, if you check the history of things, you'd have a second, a third, a fourth, a fifth, so on chance at everything along the way. Even the best of things, you'll have had another opportunity to have gotten in at maybe not the exact same price, but perhaps what would be a better IRR, even were you to pay a higher price down the line. Things tend to oscillate quite a bit around a mean. Few things tend to just absolutely run away from what I've seen. And I think the longer I've done this, the more I've found the value in that imposed patience. That's something that I've had to consciously train myself on and retrain myself on.
Yeah, I'll say, John, it again, it boils down to intrinsic and discount to intrinsic. Generally in my world, you're sitting around for years and decades in some cases, waiting for kind of the marriage of price and value to mesh. And, the reason I'll start at 1 or 2% is generally because I don't have an extremely wide discount to what I think the appraised value of the business is. And so, if I'm starting, and I'll stick a toe in at 90 cents on the dollar at 1%, 1.5%, and that gives me 11% upside plus kind of the ongoing growth of the business. Assuming the stock trades at intrinsic value at 80 cents, you've naturally got 25% upside. So if I'm starting at 1 or 2 and I'm buying at 80 cents on the dollar, I love it to get down to 70 cents where I've got, 40 plus percent, 42, 43% upside. My again, there's just lots of mistakes, and a lot of this winds up being coin flips. And sometimes things work for you. And when I say work for you on position sizing, again, it's the marriage of stock price declining sufficiently to allow me to keep buying and increasing my cost basis and increasing the size of the position in the portfolio. But I've got countless, mistakes over the years where I have got 1% in a position and it doesn't decline in price anymore. And you wind up making 2, 3, 4 times your money on too little capital. I've done that with, cyclicals and deep water drillers years ago, a couple times. And it's frustrating. I've done that too much. I did it with Disney a couple of years ago. I got, a little bit of capital in Disney at about $100 a share. It ran up to $150 at year end. And fortunately we had this COVID this year, at least in the case of being able to buy some things cheap. And I was able to take Disney from 1% of our capital to 4%. But, I was just beating myself up over the fact that I knew what Disney was worth. It was trading at 2/3 of fair value, in my opinion, a couple of years ago, and to only get 1% in and not add to it and even buy it at higher prices was a huge mistake. And so, rectifying that, not waiting for my anchored cost basis, but early on in the economic downturn this year, was able to increase the position size. But I guess a lot of it, some of it comes down to luck. I don't think there's any systematic way to do this perfectly quantitatively. So, when you hear the folks talk about there's an art aspect to it, there really is. And some of it is luck. But I think, at least in my case, I learn over time, if I've got conviction on a name and I've waited for, 10 or 15 years and I've got enough of a discount, I am going to come in north of 1 or 2 and, I'll start at 4% or 5%. I've done that with a lot more of my positions in the last 5 to 10 years, I'd say.
Yeah, I would say from my end, the conviction level that I want is relatively high, and the concentration I have in the portfolio is very high, just because I think quantitatively you're right. There's definitely an art. I think you can also, though, quantitatively make an argument that most people are over diversified in a lot of ways. And that's great for the vast majority of people, but it's not great for most active managers that are trying to do something. So I think, you get above, 15 or 20 positions, the diminishment, the benefits of diversification start to diminish quite rapidly. And I'm even more concentrated than that. So for me, a starter position really is something like 5%. I'm then horrible at buying higher. And I think it's one of the great psychological traps that I fall into. There are plenty of times where I've started buying something and it's moved up 5%, 10%, 20%, 30%, maybe it's doubled, but the information has made it so much clearer that I was right and that the future is even that much brighter, so that I should be buying even more, even though it's already moved up. And I probably 9 times out of 10 fail to make the right decision there. So that's something that I really try to work on, try to be aware of, and I still struggle with it.
Yeah, I want to share something that I think might help with examples like the Disney problem, because it's been a meaningful shift in my framework for thinking about valuation. I used to have this isolation on an intrinsic value and looking for a percent discount. And I started re-gearing my entire valuation approach towards an IRR framework. And, the thinking being my average holding period, right? I have what I've cited a ceiling at about 20% turnover. So it means I'm holding a position 5 years on average. So what I started doing is thinking about what sort of IRR I could get, bull bear base case going out to 5 years. And you notice the numbers get a little fuzzier, though you get more clarity on how you think about the position and inevitably your expectations for your expected duration with the position. So the extent of the discount between, a 20% discount to intrinsic value and a 30% discount doesn't really move the needle that far when you look out over 5 years what your expected return might be. So I figured I'd throw that out there.
And Chris, you talked about buying more when a stock goes down and actually sometimes wanting that to happen. I'm wondering if you guys consult the balance sheet when it comes to those kinds of decisions, because I feel like if a company is really solid on the balance sheet, has net cash and so forth, where you feel like this cannot be a zero, I'm much more comfortable buying more as it goes down than if it's a leveraged balance sheet where you could end up destroying all your capital because this thing could actually go to zero.
Yeah, I would. So a good example there, John. I owned a number of years ago a Norwegian 3D seismic business that had an okay balance sheet, and post 2014, when the oil price declined and materially declined from north of $100 down to $20 or $30 a barrel, you saw a lot of things, and I saw balance sheets that were okay, that had numerous off balance sheet liabilities, and in the case of the business I'm talking about, you wound up with the capital commitments to take equipment that you'd contracted out 2, 3, and 4 years, which would have been great in a normal operating environment where your capacity could be utilized. But it became obvious that capacity was not going to be utilized. And so when you stress test that, you have to go to the balance sheet. And, I've been able to swap those kinds of businesses for, and I've got a couple of them, but things like Subsea 7, which is a big position of ours that runs a pristine balance sheet, albeit in oil and gas. They're an engineering construction business. And it's, sufficiently strong balance sheet that regardless of kind of the duration and depth of the downturn, I've got survivability. So there you're measuring opportunity cost. I never want to be in a position where I permanently impair capital. And, if a business with a great balance sheet has gotten cheaper, but perhaps less cheap than the business with a balance sheet that's deteriorating, was okay to begin with, but it's now deteriorating, I'm way more inclined to sell that position, take my loss, not chase it down and increase it, in size, even though when oil turns and they wind up utilizing capacity, you wind up making a hell of a lot more money. I'd rather swap to the opportunity cost of the knowable. And so you're right. I think you have to go to balance sheet. But having said that, if you haven't done your work in advance, I'm just not going to get into bad balance sheets right at the outset. And so, the years and the decades even of having done work on businesses, I'm very seldom concerned about, a declining stock price right at the outset. In fact, more often than not, I'm only getting into a position because the stock price has been declining already. And I go into that environment with a notion that I'm never going to get the bottom. And I've got to be willing to start at a higher discount to what I think intrinsic value is. And again, cheer, which is contrary to how most clients think, but, cheer for the declining price because, we've done enough work to know that we're not wrong. But, you do get into those environments where, again, the macro climate can change. You might have disruption where you've got to really do some thinking and really question yourself as to whether you want to make, a business and a position size that much larger. So a lot of it boils down to experience. But, like both of you guys, I'm trying to jam as much money into my best names, my best ideas. And we were on, something like 3/4 of our capital on our top 10 names. And, we've got a lot of conviction in those businesses. And generally the discounts to what we think fair value is there are sufficiently wide. It's the 1%ers and the 2%ers that are there because they're new or because I've trimmed them back. And now, you're kind of waiting for a nominally lower price. And so, you look at those 1 or 2%ers or even 0.5% as kind of your farm team. And to that end, yes and no. It's you're always constantly looking at the balance sheet and management and business quality, but those things don't happen very quickly. It takes a cyclical downturn like we've had in energy to really force you to go stress test and be willing to take losses on a position size in a company that would otherwise be fine, except for the depth of the downturn, if that makes sense.
Yeah, and the COVID crash was like uniquely challenging on that front because, you could talk about what this thing might do in the wrong side, what anything might do in the wrong side of the cycle. But there are so many businesses that you might have perceived differently in an environment where they couldn't even open their doors to do business. And the entire revenue base wasn't, capable of operating in the way it was supposed to. So some of these like pre-planned, like I'm starting small, going to buy a whole lot more here. The whole playbook gets ripped up depending on how things play out.
Oh, we had to run, and I'm sure you guys did, but we ran, very deep, very credit intensive stress tests on every business in the portfolio. Even those businesses that operate with net cash and no debt on the balance sheet. When you're in a position where you wonder if you're going to lose a quarter or 2 quarters or a year or 2 years worth of revenues, all of a sudden operating leverage and financial leverage get to be really important things. And so with every business, we had a 10, 12-page report we put together on every company, stress testing. What will this business look like again and you never would have imagined this, but multiple quarters or even years worth of, revenues down by anywhere from 50% to 100%. It's an extraordinary thing. And so back to John's point, a business that you never thought you'd have to worry about balance sheet integrity, all of a sudden you're worrying about balance sheet integrity when you're running the prospect of companies that are otherwise wonderful businesses, quantifying the degree to which they're burning cash, which is an amazing thing.
One last question on this topic before we move on to Phil's topic for the week. I'm wondering whether you guys employ options to any extent because they can kind of skew, move this from kind of a linear discussion to sort of an interesting discussion around, you've got more on the upside than on the downside and so forth. Do you guys think about that at all related to position sizing?
Yeah, I use options, I don't want to say frequently, but in very specific situations. And I think they're pretty advantageous because there's an inefficiency when I go into options as stock replacement and I could think through that framework. The person on the other side is pricing with Black-Scholes for the most part. And, we don't have the same objectives. So I like options when I could use them for one of the things I like to do is I don't necessarily like to catch a falling knife, but if it's something that I really like and I really intend to own and I don't own it yet, I'll sell puts and take advantage of the premium I could capture there and begin to establish a position without putting that much capital at risk right away. And if I really like it, I'll sell puts and use that to fund the purchase of calls and effectively have no capital outlay and, not have much exposure in the range between the put and call strike. The other thing I like to do is if something's working pretty well, I mean, Roku is an example that I could use position management in a lot of different ways, but stock went up way farther, way faster than I ever imagined. And one of the promises I've made to my clients is to focus more on, long-term management. And I don't intend to give my clients too big a short-term capital gains any year ever. Like, I don't want to do that. I was able to sell calls to at pretty high strikes for pretty juicy premiums, take out the first 20% of risk on the position when it was much higher. And I thought that was pretty nice. So those are two ways I try to use it. The third that I'll do from time to time is in something that's not a very volatile security and I have a really high level of conviction. I'll buy deep in the money calls to get some really cheap leverage on the position. So those are the three ways I try to deploy options.
Great. Well, let's move on, guys. Phil, I'll turn it to you for your discussion prompt for the week.
Thanks, John. I appreciate it. So I thought this week we'd just briefly finish up kind of what we've been talking about on a corporate governance, investor relations perspective and lead into the conversation we're going to have next week with Larry Cunningham. I think will be our first guest on the show. We're very much looking forward to that. And one thing that I think will tie that all together is this concept of an owner's manual. So I'd like to actually throw this out to people and see what sort of feedback we can generate from it, because I think it's something that we can all do as investors that's actually mutually beneficial, because I think it will make us better as investors as we go through the process. And I think it will actually strengthen all the companies out there that we interact with in doing this. And so I had mentioned this a couple of weeks ago, I think, about the process I went through with Alaska. They kind of engaged me in a dialogue about how to get better in this topic, in this area. And I suggested this was one way that was kind of foolproof really for them to make an improvement. And that was this concept of an owner's manual. And of course that topic or that specific phrase is stolen from the famous Berkshire Hathaway owner's manual, but it's really much broader than that. And I had to stress repeatedly that there is no framework here that's cookie cutter. This has to be absolutely tailored very specifically to each and every company. So there are some areas that I think should be in common for every owner's manual. It should be, kind of a continuously updated, refreshed, living document, for lack of a better word, that just explains what a company and its owner should expect from each other. And that's such a basic concept, but it's so important because there are so many shareholders out there that are short-term oriented. Maybe they're indexed, maybe they're high frequency traders, but there's so many actual shareholders out there that just have no concept of what they actually own and what they should expect from the company. And likewise, the company doesn't actually call out its own shareholders for what they expect from them. So this creates kind of that two-way dialogue. It should have clear language, should have a proper use of the right metrics to track a business. So whatever the actually key performance indicators are, not just what they think Wall Street wants to hear, how management themselves actually evaluate the business on a daily, weekly, quarterly, annual, decadal time period. You have to actually publish those metrics and track them consistently over time. It should include some measure of return on capital. How you calculate both sides of that equation, the numerator and denominator, is very important, but it should be explained. There should be per share metrics, because I think that's absolutely crucial and often overlooked. It should include, some sort of capital allocation framework, and we can walk through some of the good ones there. Larry was intricately involved in two of the best there, and some sort of statement of purpose. So something about, tying the business back together to what it actually does. And so again, this has nothing to do with quarterly guidance. It may have something to do with mid or long-term guidance. Again, skewed more toward what a true owner would care about over, instead of one quarter or even 3 or 4 quarters, at least 3 to 4 years, kind of on the short end. And one thing that often gets brought up to me in this context is, you should just read The Outsiders. That's everything you need to know about this. And believe me, Will Thorndike wrote a great book, one of the very best books ever written about the framework of business and investing. I think the problem there is that people viewed that almost formulaically, that they could take that and apply it to any situation. I think Valiant was probably the most famous example of how easy it is to go wrong with a good idea like that. So we'll go into that a little bit more next week. And really one of the key things that we'll will branch out from this idea of an owner's manual and cultivating a good shareholder base is this concept of empowering quality shareholders. So Larry wrote this great paper. The title of it is The Case for Empowering Shareholders. If you just Google that you'll find it. It's a free paper. It's an academic style paper that he wrote recently, but The Case for Empowering Shareholders, you'll find it out there. And in that paper, he defines quality shareholders as high conviction and long horizon. So this gets back to what we were talking about a little bit earlier in today's podcast, was that, you have to have a high conviction if you're going to really be a high quality shareholder. If you're just sort of taking tiny little positions and you have hundreds of them, that wouldn't really qualify. And you have to hold it for a long period of time. So in this case, years. But on a kind of 2x2 matrix basis, Larry's big idea, with quite a bit of evidence behind it, is that you should actually give those shareholders more votes. And that's a controversial idea. I think it's a worthwhile idea in a lot of ways. It's not a silver bullet, but that's something we're going to be talking about a lot next week. So if people have questions, if they have things they'd like Larry to address directly, suggestions for the conversation next week, please feel free to reach out. Send me a note on Twitter and email, and we'll be sure to work that into the conversation next week.
Well, thanks, Phil, for that preview. We are so excited that Larry Cunningham will join us next week. I'm sure it'll be a terrific discussion. And now, Chris, I'll turn it to you. I know you took away quite a lot from the Berkshire release. You previewed it here with us before it came out, and would love your feedback on what was as expected, what was perhaps surprising to you.
Yeah, thanks, John. I mentioned last week that I do most of my heavy lifting with Berkshire in particular, just once a year. I sit down and I write my annual client letter, but I've always kind of gone through and rigorously built out my models and really done my thinking on Berkshire's intrinsic value and all of the accounting and all of the moving parts. And, I generally just spend very cursory time with the quarterly earnings release, but obviously we pay close attention to it. And it's interesting to see how, other shareholders and the media react to what's disclosed. I think in this latest quarter, here we are in the middle of this COVID crisis, and who knows what the shape of the recovery looks like. But it was interesting, kind of going through the press release and then the Q. There were some clear highlights that jumped out to me, and there were some lowlights that jumped out as well. I think on balance, though, it was really more positive of a quarter in terms of the progression of earning power than I would have expected. I think the railroad was surprisingly more positive. What was better than I thought. I thought income could have been down, on the order of 25 to 27%. It was down 15 and change. Revenues were down a little over 20. So some of that improvement, relative improvement in profitability was, if you guys remember, if you went to the Berkshire meeting, the Midwest, the upper Midwest just massively flooded last year. There were a lot of disruptions to the Burlington system and even the Union Pacific system in the West, the Canadian rails. And so you were up against easy comps, but I was pleasantly surprised that agriculture, continues to be pretty strong, down 10 or 12%. Coal was down close to 40%, which was expected. But I thought the rail was going to be worse than projected. They earned about $650 million against what's kind of normal in my world when I measure profitability, $750, so below where they were. But there's enough variable cost in the structure that it looked good to me. Your fuel costs were way down by 50%, and that's volumes, that's price as well. Labor costs are more variable, surprisingly more variable to most people. And so the rail was in good shape. I think the energy business was terrific. The top line was down a bit. Pre-tax income was down a bit. If you really get into the nuances, the tax rate went from something like negative 14% to negative 31%. The amount of credits that the business is earning from all of the CapEx they're spending in wind and alternative energy drove the bottom line up. Well, the pre-tax income line was driven down, but the revenues were down kind of single digits, and we expected that, just less industrial use of power. But in the case of the energy businesses, the utilities, zero long-term diminution of earning power. in a world of low interest rates, if those collective businesses can earn, kind of an allowed 10, maybe 9 on capital in a world of low rates, wonderful businesses. The rail, I think you've seen, and I mentioned this last week, but the stocks of their competitors that are all publicly traded, the Union Pacific, the Canadian Rail, CSX, what have you, they're all either at new highs or have recovered, considerable amounts of the declines through March. The insurance operations were, largely on balance, very positive, very little harm from COVID and the economic downturn. Geico distorts the profitability, but most property casualty insurers outside of auto were not going to write at an underwriting gain for the quarter, and Berkshire's collective insurance operations wrote at $800 million. I'd kind of normalize that underwriting profitability at $600, but Geico wrote at $2 billion, and that was a loss ratio that was 20% better than normal. Now, if you read the footnotes and you kind of get into the nuances, that Geico's offering credits to their customers prospectively. And so a lot of that gain or that current profit that was earned in the first quarter is going to be given back in the second quarter and even into the first portion of 2021. And so, this widely profitable combined ratio, this really high underwriting margin, is going to flip, and it's very plausible really that Geico underwrites at a loss in the back half of the year. But that's really just going to be an offset against this period of time when frequencies are down, people aren't driving as many miles, severities are up. But Geico was great. It was interesting. I was really kind of waiting to see. We talked about reinsurance, the reinsurance industry, and how COVID is affecting it last week. And our presumption has been that Berkshire's property casualty reinsurance operation would not be overly harmed. The capital in the business is so wide that even if they underwrite very badly, there's really no harm to the business. It's just that much overcapitalized with a couple $100+ billion in statutory capital, 80+% of that which resides in the reinsurance operation. And so, on the straight property casualty reinsurance line, they wrote at 123% combined ratio, which, you kind of would say, ouch to something like that. Half of that was COVID. So, the COVID development, which had been a couple hundred and maybe 25 million in the first quarter, that got bumped up by $350 million. So, Berkshire's, reinsurance losses, are less than $1 billion, half of $1 billion. And, you see the big Europeans and various others that have, already developed, had claims experience or IBNR of $2.5 to $3.5 billion. So I think a really strong highlight was the insurance operations. Within the MSR businesses that we knew were going to be very weak, there were some clear highlights and there were some clear lowlights. Clayton Homes continues to knock the cover off the ball. It's been an amazingly good business. Revenues were up 8%. Pre-tax earnings were up 13%, and that was after they set aside reserves for increasing credit losses. The home sales for site-built homes were up over 20%. The sale of manufactured homes were flat. By far, Clayton, at least for the time being, has grown into, being without a doubt the best business within Berkshire's MSR group. The auto, the Van Tool, the BH Automotive, which is, on the order of 2/3 of the retail operations within MSR. Revenues were only down 11%. Income was up. They've managed their overhead really well. SG&A was down by a bunch. Interest expense for floor plans even were down. So I think that was a bright spot. The real estate brokerage within the energy business, closed units were down on the order of 20%, but the refi business that they're involved with was up a bunch. Lowlights, you guys all saw the $10+ billion write-down at Precision Cast Parts, and there were some other write-downs. Precision has grown into what I think has been really the worst capital decision that Berkshire's made in a long time. They bought the business, I think, in 2016, knowing that the turbine business was already in trouble. The customers of the engine aircraft portion of the business and aircraft manufacturer were in cases taking processes in part. They got scammed right out of the gate by a German business that they bought that was manufacturing revenues out of thin air. And so, they took a $10+ billion write down, which you just don't really see in scale in the entire history of Berkshire. And that's on the order of a third of the purchase price. So that was not unexpected, but very disappointing. Across the industrial businesses, Lubrizol was weak. Marmon was weak. IMC was weak. You would expect that with industrial production and trade down by a whole bunch. The real one that jumps out at you, and it's not a big piece of the business, but Forest River, which is the camper RV business, that business was down 25% on revenues, and earnings were down almost 40%. If you can't make money today in the world of selling campers and RVs, I mean, you look at the competitors, Winnebago and Thor. They're knocking the cover off the ball. Every millennial in the world is in families that can't travel and aren't going to Disneyland or buying campers and RVs. And so if you can't make money today, you've got to wonder what's going on there. NetJets and Flight Safety had little write-offs and write-downs. McLean has been a problem for a bunch of years. They had some inventory write-downs, which wasn't unexpected, given there was a lot of food left in the channel that wasn't ultimately shipped to restaurants that had closed. But, that business has been in decline for 3 or 4 years, and it's just overly competitive. It's losing, money on a cost of capital basis, not doing great. Outside of the operating businesses, and I'll just I'll wrap this up pretty quickly, but Apple is just a huge highlight. I mean, I was thinking about this the other day, but and kind of scrolling through the stock portfolio, and I'll get to a couple of thoughts on the stock portfolio in a second. But Berkshire paid $35 billion or thereabouts for Apple, and they've got almost an $80 billion gain. Well, when I think about the stock portfolio, and you take where your earnings come from, dividends are $4 to $5 billion. And the way I look at it, you've got $10 billion of retained earnings at the investees on an annual basis. And so if Berkshire's made $80 billion, think about this. They've made 8 years worth of retained earnings across the entire stock portfolio. At cost, Apple was something like 10 to 15%. It's now 45% of the stock portfolio. It's been a huge home run. I mean, massive home run. I was thrilled to see during the quarter, not so much in the release, but the purchase of the Dominion distribution assets. Spend $10 billion, $4 billion of which is equity. We all saw repurchases. The media was all over it. They bought back $5 billion worth of shares, having only bought $1.8 billion in the first quarter. If you follow kind of the nuances of Mr. Buffett's charitable filings, it looks like they've bought back another $2 billion during the month of July. So, so the stock portfolio, which I mentioned, this is really interesting. We all know they sold the airlines, and I think we're going to wind up seeing the 13F filing probably tomorrow. If you play around with the footnotes of the equity holdings, and you play around with the footnotes of investment gains and losses, when I saw, and if you get into the equity investments in common equity holdings, I just pulled this out. You can see the cost basis on their banks, insurance, and finance group dropped at the end of the first quarter from $40.4 billion down to $31.1 billion. So there was a $9 billion shrinkage in the cost basis of that collective group. And so these are obviously your money center bank holdings. My first instinct was they probably sold Wells Fargo. And so right before we got on the call here today, I went and did a little further digging, because I thought it through and it didn't make entire sense. If you look at Wells, which Berkshire has owned since 1989, they've bought it in various increments over time. They originally bought it beautifully during the S&L bank crisis in the late 80s, 1990. That's when I was getting out of school, getting into the business, and banks were in bad shape. The overall stock market was cheap, but they've collectively spent $7 billion on Wells. So if you take that $9+ billion shrink in the cost basis, you would reflexively look at Wells. But if you read the footnote on for the tax component, I think everybody missed, at least anybody paying attention, it's easy to miss the fact that shrinking the Wells position or eliminating the Wells position doesn't get you to what's actually a taxable loss. So there's a nuance on GAAP, obviously. You have realized gains and losses, which are on a GAAP basis, which are effectively mark to market your unrealized gains and losses. But they disclose in the footnote that you actually had second quarter taxable loss relative to cost basis of $4.5 billion. So you go through and you play around what might have been sold. Well, you cannot have sold any of the positions that they were in a filing position. So U.S. Bank could not have been sold. Moody's could not have been sold. You've got to come up with $9 billion. And I don't think actually that Wells was sold. It may have been sold in part, but my guess is they've probably sold, perhaps all of the Bank of New York position and, perhaps all or most of the JP Morgan position, which as much trouble as Wells has been in with reputation, they've set aside $9 billion in the first quarter. I think the world, at least those that follow Berkshire, is probably expecting to see a shrink in Wells. And I wouldn't be surprised tomorrow when we see the numbers that it was actually blowing out the Bank of New York. Goldman Sachs is going to probably wind up being gone. There was about an $800 million gain. So it'll be interesting. I'd be curious if you guys have looked at this and what you're thinking. The other position that was gone that we figured out several weeks ago was Occidental Petroleum. The common stock position is gone. If you look at the SEC filings that Occidental has had to file to effectively pay Berkshire $200 million a quarter in common stock, they had to get those shares registered. And it had looked like in the interim, not only had Berkshire collected the $200 million in common stock, but that between the first quarter and second quarter that they had increased their position size. Well, if you get into the footnote itself, what you'll realize is I think they actually sold the entire position. The nuance there was the warrants, the 80 million warrant shares were not effectively exercisable, at least for reporting purposes at the end of the first quarter, but they were at the second quarter. And so what looks like an increase in Berkshire's holding in Oxy is going to wind up being an absolute blowout of those shares. So I don't think they own any Occidental, but I'll stop there to leave it with a question to you guys if you've looked at that and whether you think Wells might be gone, because clearly, they've sold on the order of $8 or $9 billion worth of the banks, and my thinking has changed having read a little more into the nuance of the footnote. So I'll stop and ask of you what you guys think.
Yeah, I'd be surprised if it's totally gone, but I wouldn't be totally shocked, but I would be surprised. I think the bet now is clearly on B of A, and I think that's for good reason, given what we know.
Yeah, I'm curious on Wells too. When Munger said something to the tune of he didn't think Scharf was fully committed working out of New York, that suggested perhaps they had one foot out the door, though I felt that was kind of unfair of Scharf. And, he seems to be hiring a great team out here in New York as well. So I don't really know. I'm curious what you guys make in general of it, Buffett selling down the equity portfolio as the market bounced too. So he did some selling in Q1 and then again. What do you think more generally about perspective towards risk and market levels, et cetera?
Well, I think he's terribly concerned, and you saw that with the sale of the airlines, which was on the order of $5 to $5.5 billion. My sense is the banks are not in as good a shape as most of the world thinks they are. We haven't even gotten to the mortgage forbearance running its course. We've not gotten to auto loans, not being foreclosed on and repossessed. The capital levels are way higher than they were in 2007. Banks have less on-balance sheet leverage in them, but the degree to which large swaths of the economy are not in great shape is problematic, with the short-term interest rates at zero and likely to be at zero or
But I mean, he's buying more Bank of America since the quarter ended, right? So if he's that concerned about banks in general, isn't that a bad place to be diving further into?
Yeah, it's interesting. I mean, I wonder. Again, I've thought a lot more over the last week that Wells was probably sold, and I'm trying to get my mind around Wells because if you look at it, it's trading at mid-single-digit multiples to what you'd call normalized earnings. I think collectively, all of these banks, doesn't matter whether it's B of A or Citi, JP Morgan, Wells, I don't think they've reserved sufficiently. They all increased reserves materially in the second quarter versus the first quarter, but go back to 2008 levels, And if you take loan loss reserves up closer to 3% of outstanding loans versus on the order of 1, there may be a third of the way there. Maybe they're, half the way there, who knows? But unless you think, if you believe you're going to get a complete V-shaped recovery, then the banks are going to be in great shape. But if not, and you think the commercial mortgage world, C&I loans, and consumer loans are going to wind up having problems, couple that with a very compressed yield curve and very, compressed net interest margins. I just think the banks aren't as great. And it's interesting to me. I can't reconcile the notion of buying a B of A and selling off either JP Morgan or Wells. Now, he did sell, Mr. Buffett did sell off a small chunk of JP Morgan in the first quarter. And that's why I think mathematically it cannot have been Wells. The Wells position, which has a $7 billion basis, still has a market value if you take year-end shares of about $9 billion. And so I can't get to a $4.5 billion capital loss relative to cost basis during the quarter without having sold JP Morgan or, certainly, the BK position, the Boney position. Hard to reconcile. I wouldn't own any of the big money center banks, but I've always thought, you sure know what the liability side of the balance sheet looks like. You really don't know, especially with these big boys, what the asset side of the balance sheet looks like. And when you get into a stress test environment like we're in now with, a lot of economic uncertainty, I'd just rather pass. And so really interesting to see the increase in the B of A.
Do you think something like American Express was touched during this period, or just not a chance?
No, there's no way. So they took a realized to cost basis capital loss during the quarter of $4.5 billion and a taxable gain of a little over $800 million. The embedded gain inside of American Express is so wide that unless they were pulling out, selective lots, they haven't bought any American Express in years and years and years. And so, no, I don't think American Express was touched at all. I really think it's BK, and I think it's JP Morgan. Again, I thought it would have been Wells given the problems that Wells have. And I think the reputation of Wells was starting to harm at some level the reputation of Berkshire and Mr. Buffett. And I thought maybe he'd gotten frustrated with that, but the math doesn't work. I don't think, given that there was a $2 billion embedded residual capital gain relative to the cost basis, that it would have been Wells. I really think they sold JP Morgan. And I think he holds, I hold Jamie Dimon in highest regard in the banking industry as far as the money center banks go, and was surprised to see the sell of JP Morgan because you weren't close to a filing position, a 10%, where you've got to file on an interim basis. So, I think the JP Morgan is gone. And again, probably Bank of New York, which has had their own sets of problems. Phil, what do you think?
Yeah, I don't know how much I have to add, to be honest. I mean, I going back to the options discussion, I actually owned some Wells Fargo via TARP warrants back in the day. This was 4 years ago plus now. It really drifted over time, and I'm sure they're disappointed in it. And I agree. I think the comment about Scharf working from New York is telling, and I think they've sold a little bit, which is telling, and we'll have to see. I mean, I think what B of A has done and the consumer franchise it has, I think that's really impressive. I mean, their operating efficiency at the community bank level there is as good as any bank in the country. So, yeah, JP Morgan's fantastic in a lot of ways, and Jamie Dimon's fantastic in a lot of ways, but it's a little bit different business, more institutional. So, yeah, I don't know. It's an interesting question, that's for sure. And I think what's probably most important is that he would feel like he's going to get, with higher certainty, a good outcome from whatever he's buying vis-a-vis whatever he's selling. He's not trying to hit big home runs with these positions.
It's amazing just looking at the long-term stock charts of all these things. JP Morgan really did the best job of all the money banks coming out of 08-09. They had the less damage done. Citi was effectively fully diluted, and that was nearly a wipeout. Wells, they all had to raise some capital. Some was forced on them. But it's amazing to me, looking at a 20-plus year chart of Wells Fargo, that the stock is below where it was in 1999, 2000. It's amazing to me that Berkshire, having owned Wells Fargo all the way back to 1989, that on a cost basis, again, some of these were bought incrementally, but on a cost basis of $7 billion, that the position size is only $9 billion now. Just very little growth of value over a very long period of time. And again, I'm surprised. Reflexively, I thought Wells was gone, and I'm surprised otherwise. And I agree. JP is a lot more institutional. Bank of America's got a lot more diversified streams of income, particularly on the consumer side, outside of bread and butter spread lending. But sitting here, as of 2 hours ago, convinced that Wells was gone, and now to think that it's probably the JP Morgan position. And I could wind up being totally wrong. We may wake up tomorrow or Saturday or whenever the F comes out and find out that I didn't know what the hell I was talking about. But I thought Wells was the candidate to go, given the problems that they have, and a lot of the mismanagement over the last decade.
But right at the moment where, I mean, they should have some familiarity with Sharp from the Visa days. I was so weirded out by that Munger remark in general, but should have some familiarity with Sharp. He seems to be bringing in some good new blood. He kind of, a bunch of old Jamie Dimon lieutenants. And it's cheap, right? It's cheap no matter which way you slice it. Oh God, it's hard to know.
My other comment on and who knows in the short term, but I'm surprised that the world didn't take the aggregate earnings release kind of better than it was. Again, if you balance out my net positives and negatives, I thought it was an outstanding quarter, and thrilled to see the share repurchases. A little disappointed that now that the stock has run back up north of the prices at which the shares were being acquired in 2019 in the first half of the year. I wonder if the sense is that the economy is going to wind up being on better footing. I still have the stock at a deep discount to what I think intrinsic value is, and would be disappointed. And this kind of goes back to our position sizing comment and how you allocate capital. There's still such an enormous amount of cash sitting there that I really wish the share repurchases had been much more material than they'd been. Enlightened to see that there's probably, like I say, another $2 billion having been bought in July. But the stock is up a lot from its lows just a few weeks ago. And again, north of the price at which they were buying it. If we're indeed on better economic footing, then I'll be prospectively disappointed if the share repurchase program doesn't continue to run, kind of at the current run rate of what they were buying in the most recent quarter and here during the first month of Q3.
Hey, Chris, if I can jump in, I'd be curious how you think about the future of the Apple position. It's very large. Apple hit another all-time high today, trading at more than 7 times sales. At what point do you think Berkshire would start trimming this?
John, I don't know. It's been such a home run. It's such an outsized position in the stock portfolio. I mean, he's got to deal with this position size the same way that three of us just kind of bantered about how we deal with our own position sizes when you've had success and a stock runs up. The reality is Apple was very inexpensive for the better part of the last decade, and only here during this last couple of years has it run up towards trading at north of 30 times what they're going to earn next year. And last week we kind of established an over-under of 5%. You've got to replace your product cycle on a regular basis. I don't know how you move, just given the law of large numbers, a $300 billion revenue business that generates a 20% after-tax profit margin, how you're going to grow it at high single-digit or low double-digit returns organically. I don't know. Mr. Buffett's proven to not be overly excited about booking net long-term capital gains. They are more adept at swapping operating subsidiaries. I don't know what you could swap and shrink the position size down. Perhaps they're okay. I mean, if you can grow Apple at high single digits, if they don't have a lot of pushback on price on the App Store, it's okay. But at 30 times a very big business with a robust margin structure, I don't know. I mean, it's a high-class problem. The stock is, like I say, it's produced $80 billion in capital gain in a short period of time. My bias would be to take some capital off the table and, pay some capital gains tax. In 1998, when Coca-Cola represented the same relative position size to the overall stock portfolio, and the overall stock portfolio was wildly expensive, they obviously bought Genray and diversified away from common stocks by picking up Genray's bond portfolio. But in the wake of that, a handful of years ago, Mr. Buffett did say that not selling the Coke position was a mistake. I mean, it traded at pushing 50 times their earning power. Who would have known that the world would get healthier and gravitate away from sugary drinks? They've done what they can to diversify away into different beverages. They've played games with their distribution assets. But he said it was a mistake to not sell it. And I hope, given the success they've had, and that it's now north of $110 billion position on $800+ billion in assets in the business, my druthers would be to harvest some gains, because I just think, the stock is more than fully valued at these points. I don't know if you guys agree or neutral, disagree, but, God love him for all the success with it. It's proven that he's been capable of investing in tech, wildly successful with a very big investment. I mean, he chunked 15% of the stock portfolio down and, made, turned a $35 billion position into 110. And, I wouldn't say that reeks of not knowing what you're doing in tech investing.
It's really interesting to think of Apple as like this massive pool of liquidity, because when you think about it, I was just like in my head running through, well, how quickly could they blow out of the Apple position if they so chose to make that decision, right? Starting to sell could sometimes have an effect on the stock once people pick up that's what Berkshire is doing. So as big as the Apple position is in the Berkshire book, they could actually sell it within 8 days of average daily volume.
Mm-hmm.
But then you contrast it with, the next biggest position, which is Bank of America. And that would take 45 full days of all, taking up 100% of average volume to blow out of it. So like Apple as a pool of liquidity for Berkshire seems to have some value in its own right, notwithstanding the valuation of the company and stock itself. It's kind of crazy to think how much liquidity you could push around without moving the needle there.
Well,
Not really sure what that means, but it's kind of wild.
Yeah, it is. And I would say that I think the bias here will be to probably sit tight just because of the tax hit and the massive cash pile that already exists. So it's good business. It's probably going to do fine. I think in similar situations, the strong preference has been to sit tight. So I wouldn't expect a whole lot to be different this time. I don't have a strong opinion either way on the valuation. I mean, it's obviously done well. It's a huge position. I don't think it's a unduly large or overly risky position in that regard, but I think it'll probably sit tight.
What's interesting perhaps is if you think about, Elliot, what you just said in terms of it being highly liquid, maybe Buffett would view it as, at this point, if he's kind of almost indifferent whether you start trimming or not, you could just keep it, but view it as akin to cash almost. In other words, you would feel like you have a much bigger war chest than the cash position alone might suggest. And maybe Berkshire, therefore, is out there with a really big elephant gun.
It's an interesting thought, especially considering, right, you could sell without moving it. And, the 10-year is what, 1%. So what's the difference? The dividend yield of Apple is just about there too. So it's an intriguing thought. Hard to know how exactly he's thinking of it, but Berkshire clearly seems to think, from the annual meeting and from the recent Q, that rates are going to stay low for a pretty long time here. So that might be factoring into it too. But it's definitely, I'd imagine you got to think of the price as pretty volatile compared to all the other options. So that's slightly problematic.
Well, the other consideration is given his tax sensitivity and aversion to paying capital gains taxes over the years, they did book net capital losses in the second quarter. And if you look at the portfolio, there've been a number of investments that really have not been great, that where you could take realized capital losses to offset any gains. If I were running the business, I would shrink the position back from 45% the equity portfolio, at least cutting it in half and making it 25%. And I think you could do some things tax-wise within the operations to use some losses and offset some of those gains.
Hey, Chris, just to switch a little bit on Geico, how do you think about the life cycle of Geico and where we are in that life cycle? And what I have in the back of my mind is just that at some point, if you do get, self-driving cars and so forth, that landscape could change dramatically. So what's kind of a way to think about the valuation of that business?
Right. Well, I've heard the case that auto insurance disappears in the event of self-driving cars, and that's not right. Pricing will change. You're still going to have an industry that writes premium volume, and premiums might decline in dollar terms because your losses would develop theoretically at a much lower level, but you're still going to write property insurance for a rock falling off of a cement mixer truck, a tree falling on your car. You're still going to have property damage claims, and so you would just see a resetting to an allowed rate of return across the industry. I think more concerning would be in private passenger auto, the what's been just phenomenal growth in market share over the last few decades. You've now got both Geico and Progressive close behind within just a handful of years, really, of taking enough market share from State Farm to the top dog position. And I frankly don't know what you do when you get to, call it 20% market share. I find it hard to believe that nationally you're going to grow much north of 20 or 25%. And so, they don't write homeowners. I've seen businesses that have struggled to grow their auto book and have taken homeowners business. Right now, you can buy a Geico auto policy, but it's underwritten by Travelers. I wonder in the back of my mind if they don't start taking on some different lines. If they don't start writing homeowners, which has not been as attractive of a line. I think in the last 3 years, you saw some management changes at Geico. I think Progressive has done a much, much better job in terms of growing their book intelligently and profitably. Geico had some issues, but these things all kind of grow in fits and starts. So it's less to me, John, an issue of disruption. The market will adjust accordingly. Premium dollars may adjust, but it'll take less capital to write those policies. But you're still going to have to write property losses, and you're still going to have to insure a vehicle. It's the product of their own success. They're now bumping up along this law of large numbers, as is the case with so many of the subsidiaries inside the business and Berkshire itself. It's just a bigger animal, and it's harder to grow. A lot of those scale advantages they had when they were young have already run their course. And so, the blocking and tackling gets harder. It gets harder to take market share. The good news is, maybe if we're in this winner-take-all environment, the reality is most underwriters in auto, private passenger auto especially, but commercial as well, are crappy underwriters and don't really earn their cost of capital. And so, Geico does have enough cost advantages with the way they distribute and the conservatism of their underwriting that, they'll make a 10% underwriting margin where the industry is losing money. Maybe I'm wrong, and maybe they can get to 30% and continue just growing through it. The insurance commissioners in the states are going to have to get, comfortable with, a business growing into that large of a market share. And I don't know how they deal with that animal when they get there. So it's an interesting question. I don't have an answer. I think there's still a runway to grow, but the disruption won't come from some of the places that people think it's going to come from.
That's helpful. Thanks. I think we're just about ready to wrap it up. Any of you guys have any final thoughts, comments?
No, I would say I'd have fun next week with Larry on the show. I'm going to be in transit with my daughter, taking her back to California to distance learn from a house close to campus, which, we live in interesting times. But I'll miss being with you guys next week, but see you in 2 weeks.
Yeah, and on a similar note, it was great to be back with you guys after the hurricane took out my power. I'm away next week. We do an annual trip up to the mountains by Lake Placid with the family before school starts. So, distance learning and all, but still we are going to the mountains to get a little break. But look forward to being back the following week and really looking forward to listening to what's going to be a great episode next week from the mountains.
Yeah, thanks so much, guys. Phil and I look forward to hosting Larry Cunningham. I'm sure it's going to be terrific. As I'm sure our listeners know, Phil has gone really deep on that subject. And so it's going to be a terrific conversation between two guys who are true experts on corporate governance and everything around that. So, Phil, looking forward to having the two of us next week. Take care for now.
Likewise, it'll be great. All right. Thanks, guys.
All the best.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.